Hey, real quick before the video starts, I wanted to send you a message. Here I am on the beach in Costa Rica, and it got me thinking that there's something that I need to share with you guys, because I know a lot of you are scared that there's a recession coming in 2023. The markets are going to crash in 2023. But what if that's not something to be scared about? You've probably heard that more wealth is built in the bear markets. And so you should be looking at this as your opportunity. The only thing that holds you back is not the amount of money you have. It's not the amount of time you have. It's the amount of intentionality. It's having the correct aim. And so I'm going to hold a workshop. I've never done this before. I'm going to invite you guys. We're going to do a workshop together. I'm going to send you out some handouts before we start. I'm going to have you go through, fill some things out. I'm going to give you some guidance. I'm going to have you make a plan to make 2023 the best year ever. First time I've done this workshop, I'm inviting you, my audience, for free. There's a link down below. I hope to see you there. Come join me. Why the odds of another recession are 99%. Now, I know that sounds like it's almost certain, but in life there's no such thing as certainties. There's only probabilities, which of course I say, and my good friend George Gammon says all the time on his channel. And so I sat down with him to dig into what are the odds of a recession. More importantly, what are the odds that he thinks that there's another big market crash coming in front of us? Why Michael Burry says there's one coming for sure. Remember, no certainties, only probabilities. We talk about that. We talk about the fundamentals of the market, what is causing GDP growth to stall. We talk about the difference of the fiat money system versus a fractional reserve system, what a sound money system looks like, free banking, and gold and Bitcoin. We talk about his run-ins with the Bitcoin community, the diffusion of innovation, where we're at in the market cycle, and so much more. This is a great interview. Always a good time hanging out with George. Let's go ahead and jump right into it. All right, so we've been having fun, George, but let's get into some meat here. So I got a lot of questions I want to ask you. I want to talk about the economy and the 99% chance of recession that you're talking about. I want to get into assets, buying them when they're cheap and when they're expensive, and some stuff you've been talking about on your second channel, Rebel Capitalist channel. Anyway, let's see how much we can get through. Of course, you need no introduction. Everybody on my channel should know you by now. George Gammon, amazing macro addict, as you call yourself, and I like to call you a good friend as well. So, George, let's just jump right into it. YouTube. The algorithms, I think that the people like the fear porn, right? I made videos like that are hopeful, and people just don't seem to like them. But when you talk about the world coming to an end, it seems like YouTube likes them. I mean, do you see the same thing?
Yeah, I think the balancing act for me is I just try to stay authentic and do videos based on what I'm personally thinking about. And I'm someone that believes that the fundamentals of the economy are incredibly unsound. And I also believe that most people are in the dark about how these fundamentals could impact the future of the standard of living for society at large. And, they're going to listen to CNBC, and they're going to hear just buy the dip. They're going to hear, 60-40, the portfolios or the economy's booming. Remember, Biden comes out and says the economy's on fire, blah, 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 blah. So when I hear that, I get plenty of that, positive kind of opinion. And for me, I always am very skeptical, and I'm a contrarian by nature. And especially when I hear something from a central planner, the government, or an authoritarian, I step back and say, wait a minute, whatever they're saying, the opposite is probably true. So that's what kind of leads me down the path, and that's why I'm thinking about some of these, we'll call them fundamental cracks within the economy, and therefore that's what I'm talking about on my channel. And when I kind of think through it, I'm like, you know what, I think this is actually, or hopefully, a service to most people, because they get kind of the risks from maybe my channel and your channel, and then they get kind of the more rosy view when they talk to their financial planner, or they listen to Dave Ramsey or Susie Orman or CNBC. So I think that we, at the very least, we have a balancing effect But then, of course, I would argue that we are most likely correct and they are wrong based on the probabilities.
Yeah. So that's what I want to talk about. You say that all the time. There's no certainties. There's only probabilities. And so let's talk probabilities. I made a video and I said, is it 100% guaranteed the markets are going to crash? 100%. Or is it 90%? Well, if it's only 90%, let's take a look at that 10%. And people didn't. I'm unsubscribing. How dare you say that the markets aren't going to crash? I was like, wow. I was just like, I want to look at the probabilities. Now, you made a recent video on your channel. The odds of recession are 99%.
Yeah.
So, okay, then there's a 1% chance they're not going to crash. I mean,
and the only reason I didn't do 100 is because there are no certainties.
Because there's no certainties. Now, I want to talk about that, the probability of that, the base case. But you just said something before. You said the fundamentals of the economy are unsound. No doubt. When you look at the data, I mean, any data you want, I mean, it looks like there's absolute bloodbath. But we also learned, if we didn't already know, we learned in 2020 that the economy does not equal the markets. So you literally shut the whole world down and all assets went to new all-time highs. So
And that's one of the arguments that I would have for the economy being unsound, is that it's completely propped up by asset bubbles.
Right. So no doubt, no one can argue the data, the fundamentals of the economy being unsound are there, and it's only getting worse. But they don't equal the market. So first of all, you talk about the recession. You're talking about the recession in the economy, or you're talking about asset prices falling?
A recession in the economy.
A recession in the economy.
And it could be the global economy as well. I highly doubt that would exclude the United States, because really the bond market is the global, or the treasury market is the global bond market to a certain degree. But where I came to that 99% number is just by going back to 1950, and I used the 1 year and the 10 year as far as the yield, and looking at the yield curve between those two maturities, and then seeing how often that has predicted recession. And if my memory serves me right, since 1950 there has been 11 official recessions, and the inversion of the 1 in 10 has predicted 10 of those 11. And we have never had a recession, by the way, without an inversion of that 1 in 10 year curve. Now you say, okay, George, well, that's not exactly 99%. Maybe there's some wiggle room. Look, in 1965, and that was the year, we had an inversion, a pretty significant inversion of the 1 year and the 10 year, and we did not have an official recession. And those people would be correct. But Mark, I don't know if I know you're a student of financial history, so you might know this one. But between about 5 or 10 months after that, we had that inversion in 1965, real GDP growth went from 10.1% down to 0.2, not 2, 0.2.
Yeah.
So we didn't get a recession, but I mean, is there really any difference between a decrease of 10% in GDP growth, and if we were to have gone from maybe 3% GDP growth down to -2? I mean, I think the impact on society is identical, and that's why I kind of got to that 99% number. Now I would add further evidence. So that's just when we're talking about the 1 and the 10. Now, if you look at the current yield curve, it's not just the 2 and 10. It's not just the 1 and 10. It's not the 6 month. We've gone to a point where we are today, at least last time I checked a few days ago, where the 30-year Treasury, is under reverse repo. So let me just walk your audience through that. If I don't know if you've done many videos on reverse repo, but that's the interest rate the Fed sets to create a floor on interest rates throughout the entire economy. So the Fed has the discount rate, it's got IOR, which is basically like Fed funds, and then it's got the repo. And so this is usually a spread of about 20 or 25 basis points. And right now, reverse repo is at 3.8. So why is this a floor, a theoretical floor? because this is the Fed saying that you can park your cash here, like a money market fund, and we will pay you risk-free 3.8%. It's totally risk-free. So why would anyone put their money in any other asset that yields less than 3.8%? That's the kind of the idea. But right now, what the yield curve is telling us is the economy is so screwed up. The government has created so many economic distortions, malinvestments, and misallocations of resources that the 30-year Treasury is trading below, the yield on the 30-year Treasury, below that 3.8% that the Fed sets as a floor for interest rates in the entire economy. And then the next question becomes, well, does the Fed really control interest rates? And I would say, obviously not.
Yeah.
and that's proof in and of itself. But this is how dire the situation is right now. And I could go on to the inversion and the Eurodollar future curve, and it's just red flag after red flag after red flag. And I think the only thing that the bulls can hang their hat on is the fact that we have unemployment at 3.7%. Or I guess they could say, well, we've seen the CPI come down from 8.2 to 7.7. But I would argue that just because the CPI is coming down, that doesn't mean that we're having an economic boom.
No.
I mean, just look at the Great Depression, right? CPI came way down then.
Yeah.
And oh, by the way, CPI came way, way down in 2008 during the GFC.
Yeah.
But that wasn't necessarily good for markets, was it? And so those are kind of the main dynamics that I'm looking at right now. And I think that should be not just on everyone's radar, but I think that should be front and center. And one more thing I'll add to that, Mark, is the last time I checked, and this would have been last week or so when I did that whiteboard video, the point of inversion on the curve was between the 1 year and the 2 year. Meaning everything below the 1 year, or anything with a higher maturity than 1 year, was trading at a lower yield. So the point was between the 1 year and the 2 year. Now, what I think you're going to see is that point getting shorter and shorter on the curve, right, as far as maturity. So right now, the inversion starts between the 1 and the 2. I think we'll see it go from 6 to 1, and then all the way from like 1 to 3 to where the 1 month is trading higher than the 3 month. And then the last stop is that the 1 month Treasury is trading less than Fed funds. And when you see that, that's the bond market telling you or predicting that that's kind of the rough time frame in which you'll see a Fed pivot.
I saw a chart the other day, I think it was yesterday or day before, of the global market is inverted. So they averaged out all the bond yields globally, and like the whole world is inverted on their yields.
I didn't know that, but that makes a lot of sense. I know Snyder's been talking about the German market inversion, and that's even, in his opinion, more significant or probably just as significant as the Treasury market.
Yeah. Now, when you talk about some of these things that show that potentially the economy is kind of doing okay, like the unemployment number, for example, we also know that number is super flawed. If you dig into the data, we can see that the participation rate is at an all-time low. And we can see even deeper that a lot of the reason why the unemployment data actually looks somewhat decent is because people have taken multiple jobs. And most of the jobs they have taken are actually paying less than they were before. So just because...
Yeah, that's why you can have low unemployment, but 2 quarters of consecutive negative GDP growth because productivity tanks.
Yeah. So you get everybody in the whole world working at $1 an hour. It doesn't mean that's good.
Or producing $1 an hour.
Or producing $1 an hour doesn't mean it's good. Now, again, if we go back and separate 2020, seeing that the economy and the markets do not mean anything, and so to the point, the economy is getting bad, well, let's look back just a couple years ago when we actually shut the economy down. I mean, who could have ever imagined we'd do that? But yet markets rallied to all-time highs. So now you take that, the recession, I guess typically looking at the economy itself and the productivity of the economy. And then you have another video that you did about Michael Burry predicting another huge crash. So the crash then is in markets and assets. So do you think that the economy struggling and potentially going into a recession equals markets crashing? Or I shouldn't say equal, but will lead to that, a high probability?
Yeah, yeah, I get your point. Well, Burry was talking about the economy, and then I think his point was that would definitely impact asset prices. But I think if we look, so I'm just thinking through the best way to articulate this. I do think that if we have a significant recession in the real economy, this will initially impact asset prices. But then it depends, right? It depends on the response by not just the Federal Reserve, but probably more importantly now, the government. So we go back to March of 2020. Let's use that as an example. Everyone remembers, we had the news come out about we'll call it the cerveza sickness, and everyone was just kind of on Wall Street in panic mode. And the Fed was scheduled to have a meeting on a Wednesday, and they had an emergency meeting on the Sunday prior. And they dropped rates from, I believe it was 1% down to 0. They came out and announced or committed to up to $1 trillion a day in repo. And then they basically implemented QE infinity. And the very next day, the market, the Dow, was down still by like 1,500 points. And then it continued to just absolutely plummet. And the market didn't turn around until the government came in with the CARES Act, which, let's remember, they did that in an environment where the CPI, if my memory serves me well, was sub 2%. Mm-hmm. So then the question becomes, can they do that again? But if it wasn't for the government intervention, or you could say the central planners intervening in the financial markets or maybe the real economy, I think you definitely would have seen the recession, if not economic depression, lead to a significant fall in asset prices, most notably the stock market. So that's kind of how I see it playing out is, let's say that we get a significant recession or maybe a black swan event. That's what this yield curve is predicting. Initially, the markets keep going down until the Fed does something. And based on the severity of the downturn, I think the market's either going to look at that and say, okay, that's adequate. We're still going to continue to go up because of this quote unquote stimulus, or they're going to look at the stimulus and then they're going to basically reconcile that with the level of risk because of the recession, depression, black swan, and they could potentially reject it based on the severity there. So I think there's kind of an analysis or people need to think through the probabilities of how significant they think this downturn is going to be, and therefore what the Fed or central planners' response would be, and if they are constrained at all by the current levels of inflation.
It seems like the markets are calling the Fed's bluff on this, right? Jay Powell has been very upfront of saying, we're going to crush demand, we're going to stick with it, we're going to keep raising rates. Hey, wait, you didn't listen to me correctly? Like we're pain. And yet here the markets continue to rally. They're up today a couple points. I'm not exactly sure.
Yeah, but look at what the 10-year's done, Mark. I mean, to your point, dude, right? Jay Powell comes out and is incredibly hawkish. And, we're going to crush the markets. We're going to crush inflation. We're going to raise rates to 100%. I'm the next Paul Volcker, blah, 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 blah. And the 10-year says, oh, that's nice. I'm going to go ahead and go from 4% down to 3.6% in the matter of like a week. Go ahead and give me more of that hawkish talk. So it's ironic, isn't it, that the more hawkish the Fed gets, trying to increase interest rates to decrease demand, to bring inflation down, the lower the interest rates go at the long end of the curve, which are the interest rates that most impact the overall rates in the general economy.
Right. Well, it almost seems like the markets are somewhat calling the bluff because they're like, look, we know that you're serious and we believe you. And that's kind of me talking, but like, I believe you, you're serious and you want to be the Volcker and you want to go that. And I don't doubt that. And I believe that you believe it. But there's also constraints, as you said, like when the liquidity dries up in the treasury market, like you're going to have to do something. And so it's like maybe we see like you're serious, and I believe you're serious, but we also see that you're probably going to run out of room before you want to, and you're going to be forced to act. We've seen the treasury markets getting very illiquid, acting very irrationally. You were seeing nations around the world, like Japan, notably dumping treasuries. The treasury market is obviously the biggest market, but because of all the durations, it's not quite as liquid in some areas. And so maybe people are like, well, hey, okay, like we believe you, but like we also know you're probably not going to be able to do it, and maybe that's why it's not selling off.
So to be clear, the 10-year Treasury, there's a significant bid there. That's why the interest rates are going down. Right. So I think there is concern. At least I would be concerned with the liquidity at the long end of the U.S. curve by looking at the tick data. So if I'm the Fed, I'm going to monitor that like a hawk, or the Treasury, and I'm going to notice that when you look at the tick data, it is true that you do see pretty significant demand coming in, but all the demand is from the private sector. So you see almost zero demand, and in fact, probably net selling from the public sector. And the tick data breaks this down. I wish I could remember the terms they use, but it's pretty obvious when you look at the report. So what this means is all the central banks are net sellers of treasuries at the long end. And the private institutions like the pension funds, the hedge funds in Japan, as an example, they are net buyers, and that's providing a lot of the liquidity you see. And then domestically, you're not going to have that much liquidity, relatively speaking, because obviously, who's going to buy a 10-year treasury at 3.6% when the inflation rate is running at 7.7%? So you have to ask yourself, why are these private investors in Japan or Europe buying treasuries? Why are they really kind of creating the demand side of the market? Well, it's because the dollar has been going up consistently. So if you're a Japanese investor or a pension fund, you could care less that the U.S. inflation rate is 7.7 because your liabilities or your expenses are not denominated in dollars. They're denominated in yen. So as long as the yen, or excuse me, as long as the dollar is going up against the yen, and you're betting that it's going to continue in that direction, then why would you not buy a 10-year treasury at 3.6% if the dollar is appreciating in value by 10% relative to your liabilities, right? Yeah. I mean, that's like a no-brainer. So I think that the risk there is, well, what happens if the dollar starts to go down? So like what happens if the Fed starts to become rather dovish and the dollar goes from wherever it is today, let's say 106 or something. Let's say it just hypothetically,
it is 106.
Just goes straight down to like 95. And then those public or those private investors outside of the United States, they go from, oh my gosh, the dollar's going to go up forever, to, oh my gosh, the dollar's going to go down forever relative to the yen, and then they become net sellers of treasuries. And I think that's where you could get some significant liquidity issues at the long end of the curve. The short end of the curve, I'm not worried at all, because the supply demand dynamics are far different there, because those T-bills are used as collateral.
I saw an article yesterday. I was going to screen cap it and tag Brent on it, Brent Johnson on it on Twitter. And it was an article, I think it was on Wall Street Journal, saying that the dollar trade is dead. Like the dollar trade isn't what it was anymore, or something to that effect.
Yeah, right. Right. I saw that on The Economist, I think it was. They just came out with a magazine cover that said crypto is dead, or something like that. Yeah. And of course, I retweeted that and said, maybe I should start looking into crypto.
Yeah. So so the recession is pretty much guaranteed, 99%. Nothing's certain, but looking at the data, we're on our way there. And really, I mean, the growth of the GDP has been so slow that, I mean, we're kind of in a recession anyway. Not technically, but then.
Yeah. Well, I mean, like we said, the first 2 quarters of 2022, we had negative real GDP,
Right.
and that used to be the definition of a recession until our friend Joe Biden changed it.
Yeah, and the GDP is a flawed metric we can look at anyway, especially when you look at the amount of inflation that we've had in the economy. So, but then going in, so then that doesn't necessarily equate into a market crash, asset prices falling. Potentially, the Fed could do something to keep asset prices up, and for some reason, the markets don't believe that it's going to be that bad, apparently. So where do you put that on a percentage of, are you at a, Michael Burry's predicted another huge crash. Are you at 50% we're going to have another big crash, or maybe 80%, or where are you there?
So basically, are we going to have a soft landing?
Yeah.
I would say probably 20%, 80%. 20% we're going to have a soft landing. 80% we're going to have a hard landing. And so, yeah, I mean, to your point, if I was going to argue the bull argument for the stock market, I would say we're going to have a soft landing because of XYZ reasons. So you're gradually, all of these interest rate hikes that we've seen in the Fed, that takes a long time to filter through the economy. Our good friend Adam Taggart always uses the example of the pig through the python. So the interest rates that we've had over the last 6 months, those will filter through the economy over the next 6 months, right, which will gradually bring inflation down from 7.7 down to, let's say, 6, down to 5, down to 4. And in this environment where the Fed is no longer worried about inflation, they can go ahead and stop raising interest rates. And once they stop raising interest rates, this is going to bring risk assets to the forefront again, and things like the stock market are going to rip higher, and the dollar is going to go lower, and we're going to all hold hands and sing Kumbaya as the CPI just gradually goes down below the Fed's 2% target rate from now till the end of eternity. That's kind of the rosy scenario.
And the unlikeliness of that.
I think it's pretty unlikely. But if you want to, because one of the main reasons I do think it's unlikely is going back to what you're talking about with Burry and the bullwhip effect. And I don't know if you've done a video on that, but that's really fascinating. Have you discussed that?
I did. I did a video on that bullwhip, but that was months ago.
So I don't know if you saw recently, the numbers came out for, it was Target and Amazon. I know Amazon said they were, if my memory serves me, they're laying off 10,000 people.
Yeah.
And what I found staggering, Mark, I don't know if you saw this data, but at the end of 2019, beginning of 2020, prior to the pandemic, Amazon had about 800,000 employees. Fast forward to today, basically call it 2 years later, Amazon has 1.6 million.
Wow.
They've literally doubled their workforce. They've increased it by 100%. Why? Because we had all the stimmy checks. We had all of these government distortions that gave the market a sugar rush. And then all that sugar rush goes right into aggregate demand pointed directly at Amazon. So the people at Amazon, they don't watch the Mark Moss channel. Mm-hmm. They don't watch the George Gammon channel. So they think that this new demand is just going to be there forever. They're like, oh my gosh, we're selling out of everything. We've got to grow to meet all of this incredible demand like we've never seen before. So we're going to hire another 800,000 people. And then once they hire that last person, now all of a sudden they start to see sales just completely fall off a cliff.
Right.
And they realize that, oh my gosh, holy cow, all of that demand was artificial. That was a result of, let's just say, stimmy check, something that's completely temporary. That was just an economic sugar rush. And what do? They start laying off employees. Well, listen, if, let's just say, demand goes back down to, this hypothetically, and I know it probably wouldn't, but let's just say that it goes back down to the 2019 level where they had 800,000 employees. Well, that means they're not going to cut 10,000.
Right.
They're going to cut 800,000 to get back down to that equilibrium point. And we see the exact same thing happening with Target. I think their last quarter, their profit was down by some astronomical number by like 50%. And one of the little anecdotal pieces of evidence there that I saw in this report, I think it was on CNBC, is that they attributed a $400 million loss in this quarter, Mark.
Wow.
$400 million to theft.
What?
To theft. So we're getting to the point right now where not only is this aggregate demand from stimmy checks running out, but now people are having to put all these things on their credit card. They're maxing out their credit card. They've gone through their savings, and they're quite literally having to resort to stealing the things they need just to get by. And so that's why I give an 80%, and that's basically the bullwhip effect. That's why I'm giving that 80% probability to the hard landing.
Yeah. Most of that theft is probably in California because it's legal. So,
Yeah. Well, that definitely doesn't help. Yeah.
If you make it legal, guess what? More people are going to do it.
Right.
Man, there's so many things that I always love talking to. So many things I want to talk about here, but I'll have to. So many little rabbit holes we can go into. I'm going to have to start chopping some of these off. Hey, just checking in during the interview. Are you enjoying it? You like my conversation with George? Well, he's living his best life in South America, traveling the world as I am. I'm here in Central America right now, and you can do the same thing. I know there's a recession coming. I know the markets could crash. But what if it doesn't matter? Like I said, it could be your best opportunity, and I'm going to show you how to build a plan to make sure you get there, right? A goal without a plan is just a dream. So I'm going to hold a workshop, the first time I've ever done it. I'm going to send you out some worksheets ahead of time, have you fill some stuff out. We're going to go through it together. And I want to make sure that you are set up to finish 2022 strong and go into 2023 and make it the best year ever. Who cares about the recession? Who cares about the assets crashing, if that even happens? So check out the link down below. I hope to see you there.
Yeah.
Let's transition where some of this into maybe some of your recent flurry of texts or tweets going on Twitter.
Yeah.
And I want to start with the piece that you already talked about, which is the fundamentals of the economy are unsound. All this manipulation has caused massive distortions. You talked about you've talked about the impact on society, all the malinvestment, all the distortions that have happened. We saw Vladimir Lenin. He said the best way to destroy capitalism is
Putin.
No, I'm talking about Lenin.
I'm sorry.
Lenin had said that the best way to destroy capitalism is to debauch the currency through inflation, arbitrary stealing, and then at the end he said the best way in that after all relationship of money is destroyed, the best way to get rich would be through gambling and theft. And so that's where we're at, right?
Right.
So we can see the obesity rate, we can see the incarceration rate. I mean, we could sit here all day and name all the problems that we see in society.
Yeah, ask Target.
Yeah, ask Target for the amount they had in theft, right? And so the impact on society, the malinvestment, the distortions, but really the impact on society. Heart disease is the number one killer in America. I mean, it's just our food. Our food is killing us, right? This Safety called it fiat money, fiat food. And so because our money is losing purchasing power so fast, food manufacturers have to start substituting cheaper products, and then our food gets worse, and then all these things. So is it worth it? You gave me some credit on Twitter because I'm able to see the cost-benefit analysis, something that you talk about all the time. So the cost-benefit analysis, we have massive distortions, massive malinvestments, and society is literally broken down to the point Target has to write off billions of dollars on theft.
Yeah.
We have, FTX, which is probably one of the biggest fraud scams that I believe that we can get into the whole conversation, but I believe it has deep ties into the government, both domestically and internationally. And these are the distortions that we see.
The problem there is that I don't know that most people understand the benefits of a elastic money supply to begin with. Because in order to do so, you've got to really, really understand the global monetary system, and how many people fit into that category. I would argue very few. One thing I'd encourage your viewers to do, if they want to kind of explore this further, is look at a chart of global GDP growth. And I actually pulled this one up on an interview I just did. Actually, I know you probably can't do a screen share, but I can give them the URL. It's ourworldindata.org/economic-growth. And really some interesting charts. One of them is GDP per capita, it's actually 1820. I've got it to 1910, but 1820 to 2018. And this is actually adjusted for the rate of inflation and the cost of living between countries. And what you'll notice, and it breaks things down by like country category, but we're kind of going along steadily here and seeing gradual growth in the early 1900s and 1920, and of course we had a little bit of a flatline dip or so in the 1930s, but then it starts to go up. But then you see what happened in the 1950s, and that growth went parabolic, absolutely parabolic. And I know that there's a compounding effect to a certain degree, but I don't think that explains just how this just skyrocketed, right? And then it goes to other charts I'm sure you've used, Mark, on the population growth and also the use of energy. And I think that it's interesting, this coincides with the not only creation, but the expansion of the Eurodollar market, which is a market that had no currency and had no reserves. It was, you want to talk about fiat, that's like fiat on steroids, right? So, and I'm not saying that's optimal. I'm not saying that's optimal. And again, I totally get that there are costs and benefits. And I think my main point here to your community and my community is, regardless of the conclusions you draw, just realize there are no certainties. There are no certainties. And that's the biggest problem I have with the Bitcoin space, or a lot of them, is they speak in terms of certainties. But same thing with the gold bugs. I just think to a little lesser degree. But going back to this chart, you see that parabolic growth, and that coincides directly with the expansion of the Eurodollar system, or this very, very elastic money supply. And it is true, let's go to a cost, that this Eurodollar system went bananas in the 90s, and especially in the early 2000s, which many would argue resulted in the GFC. And then that resulted in a lot of bad things like QE. And so these are the costs. But when you look at that GDP number, let's just say for the Western offshoots, and now I'm looking at this chart, so you'll have to forgive me here.
I have it pulled up too, I see it.
Oh, do you? Okay, so 50, the blue line, we're looking at, 15,000 roughly in GDP per capita. And in 2018, now we're at 55,000, let's call it. And so that's the benefit. Now, if you say the cost was the GFC, was it worth it? And I'm not saying that it was.
Or the cost is heart disease being the number one killer, having a high having a high fatherless rate in the homes and high incarceration rate, and
although I would argue
400 billion in theft happening, and vaccine passports locking people down,
But this is where it gets into a very interesting conversation about nuance, because I would argue that if the per capita GDP was at 30,000 right now instead of 15, although you're right, there's a massive obesity epidemic and whatnot, but I would argue the average lifespan would be probably a decade less than it even is today with all the obesity. So, again, I'm not saying there's a right or wrong here. What I am saying is this is definitely open to debate. Yeah. And that's why it gets under my skin so much when I hear people talk in terms of certainties.
Yeah. So there's so many rabbit holes I would have loved to jump down there with you, but we're kind of running out of time here. The last thing I want to jump to, and kind of still pulling on this thread, you put out a video on your Rebel Capitalist channel talking about, you showed some of the on-chain data for Bitcoin. So Bitcoin is unlike other financial assets where we have all this on-chain data, and we can see the coins on the network, so we can verify how many there are, and we can see when they're moved, and we can see what the last price was when it moved. And you were kind of making this video saying you can see see, 75% of the coins haven't moved in over 6 months or over a year.
Oh, yeah.
Right.
That was actually a video I did where I was talking about maybe being bullish.
Right. So I want to talk about that for a minute. So unlike any other financial asset, Bitcoin has transparency. The Bitcoin network is not private. It's open, but it's anonymous. So you don't know who owns these different wallets. And so when it allows you to look at this data that has just never been seen before, and allows you to start drawing some conclusions. And so for the viewers, what George was looking at is some on-chain data that shows the last time coins were moved, and you can see what the price point was on those coins the last time they were moved, or you can see how long it's been since they've moved. And so what we can see, there's like a MVRV, which is the market value realized value, so we can see what the valuation of those coins were the last time they were moved. Or the point chart you were looking at, George, was how long it's been, I believe, since they moved. And so you were saying like 75% of the coins haven't moved in over 6 months, and so maybe. I think the conclusion you were drawing is that maybe we haven't seen the capitulation in the market yet because a lot of people are still hanging on.
Yeah, but we were probably getting close.
Right, we're getting close.
Because when you looked at past bottoms in the price of Bitcoin, it was always when there was very few transactions over the last month. Yeah. And I'm not looking at the chart, but I'm just doing this kind of off of memory here. So my conclusion was just maybe, and I was just thinking this through live, doing that video. But I thought maybe, just maybe, the capitulation would be when we see this decrease or the increase in the amount of transactions while we see a decrease in price. Because I think that's something that we hadn't seen before, and that would lead me to believe that all the people that are still, let's say, hodling, for lack of a better word, but yet still are kind of maybe on the fence, and they might not sell at Bitcoin at 15, but they, once it gets down to 12, let's say, they're out, they're done, right? That would lead me to believe that maybe we've hit that moment. And the reason why capitulation is so important, not only in Bitcoin, but commodities or any type of asset, is because that tells you that, and even if there's a lot of bad news, even if there's terrible fundamentals, let's just say, that all the people that have sold are done, or all the people that will sell have sold. And therefore, even if you just get one marginal buyer, that will dramatically increase the price. So that's really kind of what you're trying to, or at least I was trying to look for and get some clues to in that chart. And if we're just talking strictly about the price of Bitcoin, another thing that I think is interesting is the fact that we've had so much bad news in the crypto space, and we're still at, I think we're at maybe 20, but it's only down to like 16 or something like that. I think that's showing some incredible resilience. But I just, especially when you combine, what I'm seeing on Twitter and in other places, I just don't think we're at that capitulation moment yet. Because in human psychology, that's when nobody on social media wants to touch Bitcoin. They've sworn it off. Everyone knows this is going to zero.
But that's the part. That's the part I want to dig into. So, what I was going to say. So you've no doubtedly you've seen the bell curve, the innovation of diffusion of innovation, right? So the way new innovations reach a market. And so in the beginning, you have the innovators, the creators, and then the second stage is what's called the true believers, and then there's a chasm before the early majority and then the late majority, right? So you've seen that chart.
Yeah. But then you get to a peak, and then you get denial,
right,
and then it goes down.
Well, that's the Wall Street. That's the Wall Street trader psychology, which I'm talking about just the diffusion of innovation. So it's like in the beginning, you just have the creators, the innovators, they're the only ones there, and then you have the true believers that come and adopt this technology, even though it's clunky and hard to use. They're the true believers. Then there's the chasm, and the chasm has to get crossed. Something has to happen in the psychology before the early majority can come. And then eventually the late majority just comes. So kind of like the internet, right? In 1995, it was a pain in the ass to use the internet. In 1997, it was a pain in the ass to use the internet. But eventually it got easy enough, and then the majority, now grandparents are using the internet, kind of a thing, right? And so the part, if we look at that chart, and if you look at that chart, again, we're not sharing screens here, but it's broken down typically by percentages of adoption. And so
Yeah.
typically you get to the true believers, and the chasm is somewhere around about an 18% adoption rate. And so I think what you're seeing in the Bitcoin community, first of all, Twitter is a very small sample of everybody. I think it's it's very, very, very small sample, and small people can be very noisy there. So it's a very small sample. But I think what happens is in any new innovation, doesn't matter what it is, you have the innovators, and then you have the true believers. And so these are the people. These are people who are here for the revolution, and revolutionaries are ready to go die. Right? They're not right in their mind, right? So any revolutionary moment in history, these people are willing to go sacrifice everything they have for this cause that they're rallying on. And they're not probably rational characters. Like, why would I go kill myself and lose everything I own for this cause that probably I'll never even see? And so you have these revolutionaries that are in this cause, and back to this diffusion of innovation, you have these true believers. I believe in this, and I'm willing to give everything for it. And you see people on Twitter say, like, look, I'm here for the revolution. I'll lose it all. I don't care. Like, this is what I'm here for. And so I think if you understand like how revolutions start, and then you understand the diffusion of innovation, which is true believers, then it starts to go, okay, well, we only have about 18 to 20% adoption. So everybody is now in this hodling phase. The market has shaken out all these people. So when you look at that on-chain data, you got to keep that into consideration. And I would say when you look at really, I think in May of this year, when you had the Terra Luna and then the Celsius and the BlockFi, and then the big capitulation came from the publicly traded Bitcoin miners who were forced to dump all they had. And the point that I think you're making, and I agree, economics can be very simple. Markets stop going down when there's no more sellers.
Yep.
Right? Very simple. And so if we've gotten rid of all those big sellers, the publicly traded Bitcoin miners had to get rid of everything. All the big blowups have happened. FTX blew up, but they didn't have any Bitcoin on their books. And now we're down to these true believers that are just left. They haven't moved their coins. They're not going to. I know you referenced Michael Saylor. I had dinner with him 2 weeks ago, and him and his CFO of MicroStrategy, and they wanted to break down the numbers, and they want people to know about this. Their liquidation level on one tranche is at $3,500. So he's like, they would have to pin Bitcoin at $2,000 to even get us out of that position, but we can post more collateral. It's like, we're not selling. Like, that ain't happening. Like, it's not.
Yeah, but that doesn't mean that the people that took out a mortgage or maxed out their credit card when Bitcoin was at 65,000 aren't bankrupt right now.
No, it certainly doesn't. It certainly doesn't.
That's my pushback for Saylor.
Yeah.
And you know, Mark, I'm incredibly respectful, and most of the people in this space, even if I disagree with them, I would consider them friends. But that's where I draw the line. I just. When people talk in terms of certainties that this is absolutely guaranteed that Bitcoin is going to $1 million, so max out your credit card, mortgage your house. If you've got a business, go ahead and mortgage it to just buy more and more Bitcoin. And when you've done that, just force your grandmother to buy it. And that's completely unethical. And I do not agree with that, not just in Bitcoin. I don't agree with that with commodities, gold, you name it. That's just I don't like to go down that path.
I would agree. I agree wholeheartedly. No one should ever do that. No one should ever risk more than they're willing to lose. And no one should ever take on credit to go invest it. I mean, maybe invest into a business that you're trying to start. But for the most part, I would agree with you on that. And for the record, I never.
Yeah, and that's what really differentiates you. And that's where I've got to give you so much credit because you're a Bitcoiner, but you're not part of the Bitcoin cult. And how I would define that, or how you know the difference, is like we've been saying, if someone's talking in certainties, that's the first step to being part of that Bitcoin cult. And you don't do that. Yeah. And then the second step would be if you notice anything that comes up is always going to be good for Bitcoin. That's the second thing. The second way that you tell that you or someone is in the Bitcoin cult is you say, well, what happens if interest rates go up? Oh, well, that's going to be great for Bitcoin. What happens if interest rates go down? Oh, well, that's going to be great for Bitcoin. You know, yeah. And then the people I'm talking about, yeah. Mark, and you're not one of them. And so hats off to you for that. And then thirdly, is that if you bring up some sort of talking point that is contrary to their belief system, do they get emotional?
Yeah.
And you don't do that. You always have civilized conversations, both you and many of the other people in the Bitcoin space. So to your earlier point, if I'm guilty of anything, it's by being too broad and being too general with the overall community. But I just think that I get so frustrated with a couple of those people that I would put into that camp that I allow myself, I guess ironically, to maybe get a little too emotional.
Yeah. Well, anyway, so like I said, I think you have any new innovation, any new technology, you have these true believers that come in first, and they're the ones that kind of push that new innovation. And so they are the revolutionaries, and they are irrational, and they are ready to sacrifice their lives for that movement. And so I think you have that. So I think you just take that into consideration. And I agree, it does get over.
No, I totally agree, Mark. I totally agree. I just think that the indicator that we're at that point where the only people left are just the true revolutionaries is when you see the hysteria die down to almost zero on social media. That'll be one of the ways. Yeah. And I now, granted, we're nowhere near where we were when it was 60 or 65, something like that. But when you start seeing the cover of The Economist, and I know this isn't pertaining to Bitcoin specifically, but when you see the cover of Economist saying that crypto is dead or whatever, this is a great sign. And so, and I know that you're differentiating between value and price, and right now I'm more talking and focusing on price. But I just want to throw that out there, food for thought. And that's why I totally get what you're saying, but I do think we still have a little ways to go until we get to that point where the only people hanging on are the true revolutionaries.
True believers, yeah. The ECB put out a piece today saying Bitcoin's on its last stand. The ECB put that out. That's the title of their paper.
Yeah, I think the more we see, the more of an indication that we are getting closer and closer to a bottom.
Yeah. All right, we've gone super long. I hadn't originally planned on having that conversation, but with all the stuff that gone on social media, I thought we'd talk about it.
Well, just on a final note here, just to put everything I have said throughout this entire video in proper context, I did have someone that was really, really trolling me last night, and they were asking me for my resume because they were implying that I was completely unqualified to have any view on, not just Bitcoin, but gold or macroeconomics in general, right? And so I think you might get a kick out of this. Let me read my response to this gentleman was, let me see. And this is for your audience too. Maybe your audience really, they may know me from Bitcoin, but they really don't know my backstory, and they don't know all of my qualifications for being a quote unquote guru, right, on social media. So here you go. If you doubted my qualifications, here they are. My CV is as follows. Almost flunked out of high school, had a 0.5 GPA my senior year. That's all D's and F's. Was voted most likely to go to jail. Never have taken a business, finance, or economics class in my life, and haven't had a job in 20 years. And then I go on to say, and you dare imply I am somehow unqualified. So, guys, Mark Moss's subscribers, take everything I say with a grain of salt. I am wildly unqualified.
I love it. That's great. All right, man. It's been great. It's been a good conversation. Always fun hanging out and catching up with you. Definitely going to be coming down and hanging out with you in South America here at some point soon. For everyone that doesn't know, check out George Gammon's channel, George Gammon on YouTube, and Rebel Capitalist on YouTube as well with daily news. And I believe you have tickets on sale for the next Rebel Capitalist Live coming up in a couple months, so check those out as well. And shoot, with that, anything else you want to say before we hang it up?
No, buddy. I sure appreciate the conversation. And as always, I had a great time. Thanks for having me on.
All right, thanks so much for listening to this video, this interview that I did with George. Always a great time having George on. He's someone that I consider a friend, one of the smartest guys I know, and hopefully you benefited. And there's a link down below. Come join me. I'm doing something I've never done before. I'm holding a workshop to make sure that you end 2022 strong, make 2023 the best year ever. You know what they say, a goal without a plan is only a dream. I'm gonna have a workshop. I'm gonna send you out some workbooks ahead of time, have you fill some stuff out. We'll go through it together, and you are going to leave ready to crush the next year. I hope to see you there.